Hi everyone, and welcome back to my channel. I have been getting a lot of questions recently from people asking me to explain the differences between growth and dividend stocks. And so I wanted to make this video and give you guys a little bit more information on dividend and growth stocks and hopefully clear up any questions you guys may have. So how can you tell if a company is a growth or dividend paying company? And the answer to this question lies in how the company treats their profits. So companies who take their profits and reinvest their profits back into the business or for expansion purposes are usually growth companies, whilst companies that pay out a portion of their profits to their shareholders in the form of dividends are dividend income paying companies. Companies such as Amazon, Facebook, and Tesla do not pay out any dividends. These companies are 100% growth focused because they reinvest all their profits back into the company in the form of R&D, acquisitions, and major capital expenditures. You will also find some companies that take more of a hybrid approach, meaning that they'll still primarily focus on growth. However, they also pay a small dividend to its shareholders. So some examples of hybrid companies include Visa, Apple, and Microsoft. So a quick way to determine whether a company is growth focused or dividend focused is to look at the company's dividend yield. So when a company has a dividend yield of 0 to 1.5%, that shows that the company is more growth focused. Companies that have a dividend yield of 1.5 to 3% tell me that they're taking on more of a hybrid approach, telling us that the company is still growth focused, but also income focused. And lastly, if a company has a dividend yield of 3% or greater, that company is income or dividend focused and is usually a more mature company that has a large moat. In recent years, dividend investing has become extremely popular as more people are looking to increase their passive income and look forward to a steady income stream in their retirement. And from my recent videos on dividends and how to invest your serve money, you know that I am mainly a long-term investor who loves her dividend-paying stocks. However, as I mentioned before, I do believe you should diversify your portfolio and have a good mix of both dividend-paying and growth stocks. So let's go over the pros of investing in growth stocks and why having growth stocks in your investment portfolio is important. The first reason why you should consider investing in growth stocks is because of total return. Dividend payments are great, but with growth stocks, you have the possibility to obtain a greater return in a shorter amount of time. You can increase your investment return anywhere from 10 to 20% in a year or even less. This won't happen every year, but when the stock is doing well, it can do very well and you can even double your money. Another pro to owning growth stocks is that growth stocks don't generate any additional taxable income, meaning you will not be taxed unless you sell your shares at a gain. Unlike dividend-paying stocks where you will have to pay tax on the dividends you receive yearly, even if you drip the dividends. So if you want to keep your taxes low, I would consider focusing on growth investments. This is assuming these investments are held in an unregistered account. My recommendation would be to hold any dividend-paying stocks in a registered account, such as your RRSP and TFSA, where the income received from your dividend-paying stocks is sheltered from taxes. On the other hand, I would recommend that growth stocks should be held in unregistered accounts, since they produce little to no income. Therefore, taxes on growth stocks will only be realized when sold, and they will only be taxed at 50% of their gain. Furthermore, if you were to sell a growth stock at a loss to your original purchase price, you may claim that capital loss against any future gains that you may realize in your unregistered account. In addition, with growth stocks, you have a better chance of staying in front of inflation. And lastly, investing in growth stocks can help you grow your wealth faster. And then later on in your life, you can slowly start to sell your growth investments and use that profit you made on those growth stocks to buy cash producing assets, which can be dividend paying stocks or even real estate. To simplify, you can use your growth investments to fuel your dividend income later in life. So to wrap up this video, I'm going to be addressing the most popular question I've been getting, and that is how much of your investment portfolio should you allocate to dividend paying stocks, and what portion of your portfolio should be filled with growth stocks. My answer to this question is to each his own, and it really depends on your overall investment goals and risk tolerance. The rule of thumb is the younger you are and the more time you have in the market to invest before retirement, you should be concentrating more on growth stocks. However, I tend to be a little more conservative and I like my dividends. So my current split is a 65-35, meaning 65% of my investments are dividend paying stocks and 35% of my portfolio is filled with growth stocks. That's it for today, guys. Thank you so much for watching, and as always, if you enjoyed this video, please give it a thumbs up. If you have any questions, please feel free to comment down below, and if you haven't already, please subscribe to my channel, as that would really help me reach my goal of getting 1,000 subscribers. Until next time, guys. Bye.